Okay, this is webinar about how to feel, how to use the financial statement. Um, we have here the three main statements that are used for financial analysis. So this is a part where we are gonna, each of you is gonna put the assumptions your of your case, and then we're gonna have a financial statements where the first one is the income statement, so everything that you're expecting to be your revenues, your costs, and how much is your net profit going to be. Then the balance sheet, where you would have paid all your assets, your debt and equity, and at the end, this is going to have to be zero. So you're going to have all your assets being backed up by your debt or by your equity. And then you're going to have the cash flows. So this is everything that involves money that will happen in the future years. So all the revenues that we that we that you're going to receive, and then for example, we're gonna the depreciation is there because in the income statement um, we take the depreciations from your revenues, but that's only for tax purposes. But here we're gonna put it back. This is an overview, and then I'm gonna go line by line. And then your IRR and your NPV. This is the goal that we're trying to know. Is the internal rate of return. So how much is your return in percentages and your net present value. First of all, what you need to do is to input here all the fixed costs you're expecting to have in the first year, and the variable cost as well. So very straightforward. Wages, this is plant, property, and equipment. So anything you have to buy, for example, I don't know if you need to buy computers, things like that. Then marketing expenditures, any services that you're going to need, for example, accounting or legal, and other costs, you should delete that and put whatever are your other costs. And then you're having your variable costs, and this is here you're going to put the amount of units you want to produce, and then the input you use for each of those, for producing each of those units. So, for example, I will buy 300 units or something like that. And then this is just adding all of what it's about, and here it's an automatic. It's automatic. It's going to bring up what is your cost per unit based on the amount of units you said you were going to produce and all your variable costs. And here we have the break-even. So what is the break-even? This is how many units you need to sell to pay your cost. So here you're going to put three different prices that you're thinking about charging. And then here, this is just the calculation is going to take your fixed cost, your variable cost is going to divide by it's going to divide by the prices. And that's going to bring you how many units you need to sell to cover your cost. Okay, so now here for the assumption. Depreciation is an account that that it's used in accounting for long-lived assets. So if you have, for example, I don't know, a car that you're using for delivery, or I don't know, other things, I don't know, any machinery, whatever you will need that's gonna last more than 1 year, then you have to depreciate that asset. So what does that mean? That means that you are dividing the cost of the asset by the amount of years that you're expecting to use that asset, and each year you're going to um, put as a cost that that amount that you have. So, for example, I have this car that cost me $100. I'm hoping to use it for 5 years. So each year I'm gonna put a depreciation expenditure of $20. The main goal of that is to put in your balance, so in your books, to have a value that is similar to what the market value would be, but also depreciation has tax purposes because you're putting on cost, and then your profit is going to be less, and your taxes are also going to be less. PP&E is what I just said, the property, plant, and equipment. So if you have, I don't know, a car or any other equipment, you put there how much you pay. This is the tax rate that you're charged in your countries. This is the interest rate in there. And if you are thinking about getting a loan, then how much will you pay? Revenue, just how much you think it's gonna be your revenue on the first year, and this you can bring it um, from the amount of produced units times the price that you're selecting, the price that you think it's gonna be your price. So we're assuming that you're gonna sell everything, right? And then variable cost, it's gonna be this one, and other cost is gonna be your fixed cost. Then profit margin, that's how much you're expecting to earn. Then interest expenditure is the again that how much you're gonna spend on interest. So how is this different? The interest expenditure from here from the one from above? Well, this one is the interest rate at which you're gonna discount um, your business for your net present value. So in there, what we put in general is the interest rate of the central bank or something like that, and in here is the interest rate that you're gonna be paying if you get a loan. So this one in general is gonna be a little bit higher than the other one. Then the net profit margin, that's what it says in there. How is your net profit margin? How much of your revenues you're getting at the end of the day after all your costs, interest, taxes, everything. Then debt repayment, how many years you're thinking it's gonna take you to repay the debt. Inventory turnover days, this is a formula that I have. Okay, so there we have your net sales over the average inventory at cost, and then you're gonna get the inventory turnover ratio. And for getting the days, you do 365 over that. And it's the same with the receivable outstanding, and the payable outstanding is your revenues over your accounts payable, and then you do 365 over whatever you got for the ratio, and then days payable outstanding is your cost of goods sold over your accounts payable, and then you do 365 over that ratio. And then here, this is for forecasting. So you put how much you think your revenue is gonna grow. In general, here we put inflation rate of your countries. Then the profit margin growth. So with time, you're gonna get more efficient, hopefully. So how much you think you're gonna improve your profit margin per year? That could be 0.5% or something like that. Then how much of your income you are going to give on dividends to the shareholders, which, I mean, it could be you, how much you're going to retain each year. and then your cost growth. So how much your costs are going to grow each year. Okay, and all this after you put the yellow part, all this is going to pop out automatically. And here in the balance sheet, you're going to put how much cash you had in the first year, how much are your accounts receivable. So um, here it's, I don't know, if you pay all your suppliers, if I'm sorry, if all of your sales are in cash, then you're not going to have anything in accounts receivable. But if you do some credit, then you're going to have it. And then inventories is how many inventories you have at the end of the year. And then your long-term assets, it's, for example, PP&E, property, plant, and equipment that you have. And accounts payable. Okay, so here it's the same that accounts receivable. So if you pay all your suppliers in cash, then at the moment, then you're not gonna have anything. But if you get some time for them, for example, if you pay a month after, then you're gonna have some accounts payable by the time you do your balance sheet. Then short-term debt is if you got a 5 years loan, for example, it's the amount of the loan that you have to repay this year, and then long-term debt is the other 4 years of the loan that you have. Then shareholders' equity. This is how much equity the shareholders have at the very beginning. So this is, for example, capital that the shareholder brought into the project at the very beginning. And then return earnings, this is going to come from last year's net profit after your dividends. So this is a formula. Okay. And here this should be zero because what this is saying is that all your assets were you obtain them by getting debt or by getting equity. Okay, and then we have the cash flows. Again, the cash flow is everything that involves cash in the company, and then um, you're going to have the revenues. The depreciation doesn't involve cash, but above um, we take depreciation from your income, and that is actually not an expenditure that is using cash. So this is just here we're just fixing it. So we are adding back the depreciation. Then we're having the change in account receivable, and this means that, for example, if our accounts receivable increase, then we are expending less. We're using less cash right now, and then we have to add that cash back. And then if the changing of if, for example, accounts payable decreases or increases also, um, we're using more cash right now to pay those accounts to I'm sorry, I made a mistake there. It's the opposite. If accounts receivable increase, then we are not getting cash this period because we are giving credit to our clients, and then we have to take that cash from the cash flows, the cash that we didn't reflect in the income statement, and then if accounts payable increase, then your account then you're getting credit from your suppliers, and then you're not using that cash this period, and then you're adding back that cash. And changing inventories is the same reasoning. Okay, and then we have debt repayment. How much of the debt you repay? Dividends and cash flow from financing. Okay, but all of this it's gonna be automatically like it filled up. So you only need to do the yellow part. And also here you're going to have your internal rate of return and your net present value. And those are the points that you're going to use for comparing these projects to other projects and seeing where it is profitable or not. Okay, I hope this was helpful. Again, everything you see here should be very easy to Google. But also we're gonna be having some yeah, some kind of webinar or something like that where you can ask us stuff if you are struggling with it. Thank you so much and good luck.